It does take us to our talk of the tape, the rebound, and whether you can trust it. Let's ask our panel. Dan Greenhaus with Solus Alternative Asset Management. Stephanie Link with Hightower. Courtney Garcia with Payne Capital. Steph and Court are both CNBC contributors. Everyone here, as you can see, at Post 9. We're having a little party over here. All right, Steph, can you trust this bounce back? Because it's been pretty darn strong from the April intraday lows. S&P's up 4%. Russell 2000 up 6.5%. The NASDAQ up almost 7%.
Yeah, I think you can because earnings are coming through better than expected. The growth rate year over year for the first quarter is about 7.1%. If you exclude Bristol-Myers' $12 billion charge, that number's 10%. No one was talking about 10% growth. But why I think it's important, because I think it's sustainable. I think in this year you're going to see 8 to 10% earnings growth. And why is that? Because the growth is coming through. I know everybody's focused on inflation. I am too. But the growth is better than expected. We are running about 2.5, according to some GDP trackers, north of 3 in the economy. A lot of that is because of the job market. We all talk about that. The 3- and 6-month average non-farm payroll number, even though it was weaker on Friday, it's 242,000. The average for the last 10 years is 166,000 per month. So that's good. That's leading to better wages. That's leading to a better consumer. And then we can talk about this, Scott, in more detail if you like, but manufacturing, we talk about the grid. We talk about green, clean, electrification. I will tell you, out of all the conference calls that I listened to during this earnings season, that is the #1 theme and the most powerful within all of the sectors in the market.
Do you think the bulls have the upper hand? Once again, that last week cleared some friction out of this market. Powell was not nearly as hawkish as I think some people feared he'd be. Earnings last week came in pretty well. Yields are calmer. You look at the bond market today. Obviously, the 2-year, 10-year are down fairly significantly from the boiling point of early last week. Are we all good again?
Yeah, I agree with a lot of what Stephanie got to. I would just add to what you just mentioned, which is on the rate side of things. And I think there's a underpinning the rally, at least in the short term here, is a belief that at least for the moment, rates probably peaked out. The jobs report played into that. The ISM number, which dipped back below 50, played into that. And so you're getting a bit of a slowdown in some of the macro data points. The commentary coming out of an otherwise good earnings season isn't universally bullish the way that perhaps it has been over the last couple of quarters. And so that's put a bit of a cap into yields. And so, again, in the short term here, that's giving a bit of a lift to the market. And if that proves to be accurate, that we are sort of getting more concrete data that rates are done going up, then to Stephanie's point, I think that probably underpins a broader, more long-lasting rally.
You agree, Court?
Yeah, and I think what's great is earnings has been really positive, both with the amount of companies who are beating earnings and by the amount that they're beating are both above their 10-year averages. But that's backwards looking, and forwards looking are also seeing the forwards earning per shares increasing because corporate management has been overly, generally speaking, more optimistic than pessimistic, meaning the future is looking positive. We're not expecting we're going into a recession. And you are continuing to see, which to your point, the consumer is strong, which is what's continuing to lead the market higher. And you are seeing the S&P is now above its 50-day moving average, which is positive momentum. And about 3/4 of the S&P 500 companies are above their 200-day moving average. So it's a broad market momentum, which I think is a really positive sign as we look forward
here. Steph, you're really hanging on the fact that the stronger growth is much more important to you, it sounds like, than inflation, which you admit is still sticky. David Solomon, Ken Griffin out at Milken talked about that. By the way, Ken Griffin said during his presentation that the Fed is either going to cut in September, and if they don't do it in September, they're going to do it in December. For some, that's enough, that as long as you know a cut is coming at some point and the economy is as strong as it's remaining, then that's good.
So I don't think we're going to see a cut this year. I think growth is going to hang.
At all?
No. Not at all. We've talked about this for the last, say, 4 or 5 weeks. I've been thinking that because I don't think inflation is going to get to the 2% level or even 2.5%, whatever the Fed really wants it to get to. And the reason is not only because the U.S. growth is strong and above trend, but we have global growth around the world that's stronger than expected. We saw 5.5% growth in China GDP. The sequential annualized number in China for GDP is 6.6%. India is growing 7%. Japan in the low single digits. IMF also increasing their estimates. So the growth is hanging in.